Hello and welcome. It's the GenWealth Radio Hour, and the What's Happening segment starts us off. Hi, everybody. I'm Scott Inman. For this first week in April, happy Easter to everyone. If you celebrate Easter, hope you have a great weekend celebrating with your family and going to church services. I am joined today by Alec Darrell, an advisor in the West Little Rock office on the team here at 3 Financial Center, as we dive into some headlines that are making news, I guess, in the financial world, at least mostly online or on social media. That's where our marketing staff kind of scours what's there and brings it to us, because I do think in most cases there's at least some clarity, some clarification, or at least perspective that needs to be added to a lot of the noise that is out there, Alec. And I know you see it, right? I mean, you work with people who probably bring it into the appointment room thinking they know something about something that they've heard online and finding out that maybe they don't really have all the information they need to make a good decision.
Yeah, no, we see it all the time. And, you know, being a financial advisor, a lot of the stuff that I run into online is tied to finance and investing, insurance, everything. And I will say it's more common than not to come across bad advice and stuff that just, it's not really true. And maybe that's true for some people, but for the majority of Americans, it's not. So we're going to dive into a lot of stuff that is out there that people are saying that some may be good, some may not be so good.
Yeah, and if it's not bad advice, it's at least incomplete advice, right? I mean, it's not taking your personal circumstances into account. And I'm susceptible to that as well. You know, I mean, they call it the doom scroll, right? I mean, if I'm rolling through Twitter, if I'm on there very long, you know, I follow a lot of financial type accounts, and man, the dire predictions that are out there. But the reality is they're always out there. So, hey, we're going to start off with an Instagram post, and it's about a minute and a half. Check out this. It's entitled "The Biggest Scam in the Financial Industry."
Do you want to know one of the biggest scams in the financial industry that no one talks about? Life insurance. But not just any life insurance, a very specific type of life insurance. The life insurance I'm talking about goes by a very specific set of names: whole life, permanent life, index universal, or IULs. If usually someone you know, comes to you selling permanent life insurance as an investment, turn around and run the other way, because they are trying to pull a fast one on you and you will regret it. These insurance products are typically marketed with language like tax-free income in retirement, no stock market losses, guaranteed growth, better than your 401k. And the salesperson usually uses fear-mongering to sell them to you, telling you that you're going to lose all your money in your 401k when the market goes down. But with their life insurance product, you're going to have guaranteed income in retirement. The problem is these products are expensive, and you're going to pay thousands a year in premiums. And the insurance salesman makes a huge commission by selling it to you. The worst part is, once you realize what a huge scam it is and you want out of it early, you'll probably pay a high penalty fee. The reality is, using the money you would invest in premiums to instead invest inside your 401k and your IRA and buy index funds is a much better option and will provide you better returns over the long term than any permanent life insurance would.
Hey, first of all, I've got lots of questions about the video. I mean, why aren't we cooking waffles in our kitchen while we're talking about permanent cash value life insurance? And I'm sure there's a reason for that I don't know, because I don't follow her. But look, there's a lot in there, and she makes some pretty big claims against whole life insurance. And I would say a lot of them are true. A lot of them are true, and we're not big proponents in most cases, although I do think it has its place in certain cases, but we're not generally big proponents of cash value life insurance. We believe very much as advisors that you should look at insurance as an income replacement for a certain season of life. That's the role of life insurance in most cases. So usually you don't need it for your entire life, and if you've done the right things to become financially independent, at some point you're going to be self-insured. That's what we would say, right? So then term life insurance, usually, Alec, is the best option for most people.
Yeah. Term life insurance, it's the most affordable way to get the most coverage. Out of all the different insurance products there are, it typically is the most efficient. And it's you use it when you need it, and then when you don't need it, you don't have to pay for it. And so we really like it for that aspect. Like you mentioned, it is for income replacement. So if something were to happen to one individual and they are a breadwinner in the family, their income would be replaced by the death benefit that the life insurance gives. And like you mentioned, if somebody gets to retirement and they're no longer bringing home income every year from their job, they may not need retirement anymore, or they may not need life insurance anymore. And it also gets more and more expensive the older that you get.
Yep.
So I think getting covered for a certain window is really what life insurance is for, and term insurance is great for achieving that goal.
Yeah, and so when you talk about permanent or whole, or as she said, indexed and universal life policies, they're oftentimes combining insurance with a cash value component. So you think about the expense. When she says they're expensive, they are relative to term insurance, because you're just paying the smallest amount of premium for the biggest amount of death benefit you can get, because you're only going to need it for a certain time of your life, while the cash value component, or the whole life insurance policies, you're going to be covered for your entire life. And then part of it does go into a savings or even an investment vehicle where you can potentially grow that money over time. But the question is, do you really need that? And I do think there are times where it might apply. You know, I think about we do have some firefighters as clients, and they have a pension. And many times those clients have chosen the single life option, right, or the life-only pension, meaning that if they die before their spouse, there's not going to be a pension check to be passed on to their spouse. So oftentimes they will have a life insurance policy that is going to cover them for their entire life. It doesn't have to be cash value, but it is permanent. It's maybe a UL, universal life, that doesn't build cash value, so that it kind of replaces the pension that is no longer there, and a lump sum tax-free death benefit will be able to go to their spouse in that case. And there are other times too, Alec, that there could be a place for cash value life insurance. So, you know, I'm as I watch that reel, I'm in lockstep with a lot of what she's saying, because we're not big proponents of cash value life insurance, but I do pump the brakes on never use it. It's a scam. It's not a scam. It's just maybe not right for everybody, but there could be times where it's useful.
Mm-hmm. Yeah, there could be. The example you gave, I thought, was a really good one. I've also seen people use it for when they're not insurable with term life insurance.
Yep.
That could be somebody with maybe a terminally ill disease, and that's the only way they could get life insurance. I've also seen certain people with high net worths use it for passing on a tax-free legacy, but you really got to get into the weeds on those policies and make sure that it is a policy that's built right for you, because there's a lot of different levers and a lot of variables in those, and things can change over time. So I think it's really important to have a good grasp of what your goal is for this policy, what the policy does and how it's structured, and making sure it aligns with that goal, and then, see if it makes sense. One thing I will say, I think get different opinions on it, because if you're talking to one guy who wants you to get it, it may be good to get some statements, get some ideas about what it's like, get a second opinion, because they are set up a little complicated.
Yeah, and I'll say one last thing. She mentions claims of tax-free income in those policies. Those claims could be accurate. You could get tax-free income, but you have to be, and this is a final warning sign, because there are people out there all the time talking about tax-free income in retirement using a cash value life insurance policy. But you've got to pay a lot of taxes to get to that tax-free income, because what we see is people out there peddling, hey, cash out your 401k and buy a whole life cash value life insurance policy, and you're going to have tax-free income in retirement. Yeah, that's actually, the back end of that's correct. But why in the world, you're going to have to pay tons of taxes to get to that tax-free income. So it's not going to make sense. So yeah, beware of, hey, tax-free income through a whole life cash value life insurance policy. All right, we've run our time on that one. Let's go to the next what's happening topic. The Iran crisis making this retirement strategy look better than it has in decades. This is from Market Watch. It's an opinion piece, and it's basically talking about, would you believe, annuities. So why the Iran crisis is making annuities look better? Well, it's because it is pushing yields up through the last few days of trading, or the last few weeks, I should say, of trading since the conflict began. Bond yields have ticked up on corporate bonds by about 0.5%. We've seen the 10-year Treasury bond yield also go up about 0.5%. So the opinion piece is basically saying because of this, annuity withdrawal rates are rising or will be in the future. And we've seen that. That's a trend that actually is continuing, going all the way back to 2021. So I don't know why it's particularly tied to the Iran crisis, although maybe it is making it go up even higher. But we've seen since 2021, Alec, with inflation rates being almost to double digits year over year there for a short time, that annuity withdrawal rates are up. And this opinion piece, though, is actually specifically talking about what is in the industry called a SPIA, a single premium income annuity. And it's saying if you put $100,000 in an immediate annuity, you can now generate about $600 to $650 a month for a 65-year-old, and those are levels not seen since the early 2000s. So I don't know really why we're looking right at single premium annuities or immediate annuities. We do use income annuities in our planning here at GenWealth, but we don't use them just because bond yields are rising, right?
Right. Yeah. When we're looking at annuities, we're really looking at having another source of guaranteed income. So your guaranteed income sources would be Social Security. If you maybe worked for the government or your company had a pension, then you would have a pension. So that's another source of guaranteed income. And then there's also annuities, which is similar to just purchasing a pension. Now, with the way the market has been right now, and we've seen the S&P 500 down year to date. It's down about 7% while we're recording this. Having that source of guaranteed income seems very attractive because if you are very overweighted in equities, your retirement portfolio is taking a hit right now.
Yeah.
With interest rates making rates on annuities look good, I don't really have an opinion on that because it's going to change a lot. Right. Interest rates consistently change. How that has to do with the annuity market, it's always changing just like the market is.
Yeah, and I think it's important to say too that annuities are complex products, and you should never enter into one of those. This is not investment advice for you specifically. We're just having a general discussion on annuities. They can have key features that you need to understand. They can have higher costs that you need to understand. And then the other thing with relation to this conversation is they come with a surrender period. So the idea that, hey, you want to stick all of your money in an immediate annuity or any kind of income annuity is not wise. You have to have some liquidity because those surrender periods can be 5 years, 6 years, 7 years. I've seen them as long as 18 years, if you believe it. Wouldn't go into one of those. So you can't get your money out of it if you need it. So it needs to be a limited percentage of your overall liquid net worth if an annuity is right for you. But again, to Alec's point, it should be discovered in the planning process, not just because bond yields are up. And you're right, those yields could go back down tomorrow, and those withdrawal rates are not as attractive. And then a thing I think about, too, to wrap this piece up, is you look at inflation. The other piece of that is whatever you get out of the annuity is going to be guaranteed for life, and it is going to be an additional paycheck for you, but it's not likely to go up. So you still have to have not only the liquidity of having some of your portfolio outside, a significant portion of your portfolio outside of the annuity, but you also have to have it invested in asset classes that are going to grow so you can give yourself raises in your retirement.
Yep. As we've talked about probably 100 times on this show, what income you get today in retirement is going to be way more that you need in 20, 30 years. I'm feeling that now with gas prices this week. Things change, things get more expensive. So making sure that you're hedging some big risks. It's not only having secure income, but making sure that you have secure income for the next 30, 40 years, however long your retirement is.
Yeah, so a couple of insurance products in the crosshairs today in the What's Happening segment. When you talk about annuities, you talk about cash value, life insurance. But again, it goes back to what we said at the beginning of the piece, and that's, man, when you see just limited advice It also could be bad advice. Don't make an investment decision that could impact you for a long time in your retirement based on what you see on social media, based on what you read. I mean, we talked about that's from Market Watch. I mean, that's certainly a legitimate opinion piece. We're not knocking the guy's opinion, but don't go out and buy an immediate annuity just because you read an article. The best way to discover what's right for you is to walk through a planning process with a trusted financial firm and a financial advisor that does planning first, and then your investment strategy will be built based on what the plan says. All right, that's going to do it for our What's Happening segment on the GenWealth Radio Hour. Stay tuned now. The Get Ready for the Future show is next.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
We help people discover, protect, and share true financial independence at GenWealth Financial Advisors. And on this show is the Get Ready for the Future show, offering up education and some action steps based on questions that you have sent in. Welcome. My name is Scott Inman. Alec Darrell out of the West Little Rock office with me today in the co-hosting chair. And if you've got a question for us, I want to start off by asking you to get it to us. If you're listening today, you're watching today, something's been on your mind that you want to know about with regards to your money, retirement, investments, whatever it is, don't hesitate to reach out to us either with a voicemail or a text to 501-381-5228. Again, it's 501-381-5228. Nothing's off base. Nothing's off topic. Whatever you want to know about, get a question in to us, and we'll be glad to basically give you some information about it, because that's what we exist for. Not to give you clickbait, not to give you a viral video like we talk about sometimes in our What's Happening segment, but to give you clear information that you can use. So you ready to dive into our questions?
Let's do it. I'm excited.
Lillian from North Little Rock is first, and she writes, we have $150,000 in a savings account earning almost nothing. What are our options for getting better returns without taking on big risk? Great question, Lillian. This happens oftentimes in our appointments here at GenWealth when you talk about people getting close to retirement, and Lillian doesn't tell us how old she is. But I think it's important to note that there is an amount of cash that we would tell you is probably too much. $150,000 is probably, unless there's a big lump sum purchase coming in the near term, I would say that's a little more cash than someone needs. Now, you do need to identify out of that $150,000, how much do you need to keep for an emergency savings? We do not want to take any risk with that. And I would even say stepping into anything like a CD is maybe even a little bit of a stretch for the emergency savings, because if you need it tomorrow, if something happens like you have a car accident, you need to go to the body shop, you need to repair a roof on your home because you have a hailstorm, and you have to meet the deductible before you get into the insurance company's pocket, you're going to need that in cash. You're going to need it liquid. You're going to need it safe. What is that? Well, 3 to 6 months is a good rule of thumb, 3 to 6 months of living expenses. But I also kind of think about it's a number, Alec, that you have to be comfortable with. But I would certainly say in the $20,000 to $30,000 range. So we probably don't want to put all of that $150,000, unless she's saying the $150,000 is extra, at risk there. But let's now move past the emergency fund discussion and talk about what we need to take into consideration, or what Lillian needs to take into consideration when deciding what to do with the excess savings.
Yeah. So you got $150,000 in savings. Like you said, shave some off for emergency savings. We think everyone needs that. And once you've got that money set aside, I think you really got to ask yourself, what is the purpose for this money? Is this a short-term need, like I'm buying a home or buying a car in the next few months, or is this just money that I want to have saved for one day? And so once you figure out the purpose, that's going to tell you your time horizon. So how soon do I need this? If if that goal is in the next couple years, then you may want to have something a little more conservative. I think CDs or money markets, some safe investment that doesn't have a lot of risk that can still get interest is great for a goal that's in the next couple years. Now, if you don't have a goal in mind, or you're like, this money I don't need for 5, 10, or 15 years, I think the further and further out you get, the more risk you can put on the money. And not risk as in, let's all put it in Bitcoin and see what happens.
Right.
But I think more of, maybe we look at some mutual funds or a balanced portfolio where we can get a little bit of upside in the market. And, if the market is down like it is right now, that's okay, because I don't need this money for 5 years or 10 years. And so it has plenty of time to recover, and you're actually growing the money. You're not just keeping up with inflation. You're beating inflation and making your money work for you.
Yeah, we talk about a balanced portfolio. Most of the time we're referring to a percentage allocated to stocks, or what we would say would be ETFs or mutual funds, so not individual stocks, to Alex's point necessarily, and then some percentage of the portfolio allocated to fixed income or bonds. You could also even consider the alternative space. There are some alternative investments that would become, in most cases, a little less liquid, but might provide you some tax advantages, like a real estate investment trust, where that's more of a moderate type investment in between kind of the higher risk stocks and lower or more conservative, lower risk bonds. It would be somewhere in the middle, might be a little bit lower volatility approach that could give you a distribution along the way that actually might be tax advantage to you. And you could ask questions with your financial advisor about that. So that's the other piece I think about. The risk piece, the time horizon, very important. But then you've got the taxation issue, because if Lillian's got the $150,000 sitting in her bank account drawing next to nothing, she doesn't have to worry too much about taxes. You start growing that money, you're going to be exposing that to potential capital gains tax. So there are other things you could look at that might actually be able to provide some tax deferral on this money. So again, making sure you've checked the boxes of, I can put it away for a little while. I can allocate it for long-term growth. If those boxes are checked, you might even look into something like an annuity for tax deferral, an investment-only annuity. There are products out there called a registered index-linked annuity. And again, we had discussions about annuities in our previous segment or on the GenWealth Radio Hour. So we want to tell you that annuities are complex products. Don't enter into that. This is not specific advice to enter into that. Make sure you consult your financial professional before doing so. I would say that, just as an example, a registered index-linked annuity, Alec, if we talk about how that works, you could take a portion of this money and put it into that. It is a crediting strategy, so you put it into that for a surrender period of 6 years in most cases, and the annuity company will provide you the upside of the chosen index. So let's say, as an example, the S&P 500 index, that's the one most people know about. It's the most quoted one for sure. It's a benchmark, considered benchmarked by many investment firms, and it's the 500 largest, roughly the 500 largest companies in the United States. So over that 6-year period, that annuity tracks that index performance and credits you the performance of it. You get the upside, but on the downside, you might get a certain element of protection. So you're, let's say, as you talked about, let's say the market is down for a significant period of time, you might have a 20% buffer on that money that the insurance company would protect you against loss. So again, just an example, not specific investment advice, but if you think about being able to put that away for a long period of time and needing long-term growth out of it and adding tax deferral to the mix, that is an option as well. Bottom line is, we can't tell Lillian exactly what to do with it based on her question. She needs to reach out and talk to an advisor. Mm-hmm. Yeah. All right. Thanks for the question, Lillian. Hey, if you want more free info about retirement, investments, and your money, subscribe to our YouTube channel. You can just search for GenWealth Financial Advisors online and subscribe for all our latest videos. Next, it's Johnny via text message. I'm 65 and still working. I have a large traditional IRA, and I'm worried about RMDs later. Should I start Roth conversions now? Well, Johnny, that is on a lot of our clients' minds as well. We have a lot of conversations about Roth conversions, and a lot of people are wanting to do it. And as we walk down the road of making sure it makes sense, sometimes it does, sometimes it doesn't. And then we get to the part of paying the taxes, which we're going to get to in just a second. And that is a big stumbling block as well. So some clients it's right for, some clients it's not. Let's talk about it. First, let's give some education for everybody else listening. When they hear RMD, let's tell you what it means. It stands for Required Minimum Distribution. And what that means is there's going to be a point in time, based on your age, that the government is going to require you to begin to take out a certain amount. It is a percentage. It's actually a life expectancy factor, but it basically boils down to a percentage of the value of all of your qualified investments like IRAs and 401ks. If you were born before 1960, that is age 73. If you were born 1960 or later, your RMD age is 75. So to Johnny's point, if he already has a large traditional IRA and doesn't touch it until he has to, that could be fraught with problems, because if Johnny is 65, he could potentially double that IRA between now and the time he has to start taking money out, and that could create lots of problems.
Mm-hmm. Yeah, because they're going to start making you pull out, well, at least when you get to RMD age. It starts out at about 3.8% right when you have to take RMDs. And then, like you said, that number keeps getting bigger and bigger the later you get into retirement. And if you're talking about someone who maybe has a couple $1 million in pre-tax assets, they could start making you take, a hefty 5 figures or 6 figures a year in that scenario. And that's taxable to you, and you may not even need that money. So the great thing about Roths is there are no RMDs. So that's why a lot of people ask, should I do that? And the answer to that question is it depends, which is a common answer on here. But it really depends on your current scenario. Talking about Roth conversions, what you're actually doing there is you're moving money from a traditional IRA to a Roth IRA, and you're paying taxes now on the amount that you're converting. And what you're doing there is, like I said, you're avoiding RMDs with your Roth assets, as well as future growth and withdrawals are tax-free. So there are benefits, but Scott, why or when does a Roth conversion make sense?
Yeah, so I think the key thing here is if you expect to be in the same or a higher tax bracket in retirement than you are now, then a Roth conversion makes sense. So if you let that sink in a minute, if you're very close to retirement, that's probably not a box that's going to get checked very often. The reality is you're in your highest earnings years when you're in your 60s, right, in most cases, and you're going to step down that income when you reach retirement. So you're likely going to be in a lower tax bracket, at least based on today's tax brackets. Now, there is some prediction that goes into this, but it's a pretty strong prediction that taxes are going to go up before you die, right, because where we are with the U.S. debt. So there is that component to it. You could potentially expect to have a higher tax bracket later than you would currently now, but it is still worth thinking about. If you're going to actually be in a lower tax bracket in retirement, then why would you take money out and convert it now at, let's say, the 24% federal tax bracket, when actually if you pull it out in retirement, you're only going to pay 12? That doesn't seem to make a whole lot of sense. Where it would make sense is my buddy Alec over here, who's in his 20s. He's got a lot of higher earning years coming. He would convert now, and not only, Alec, in your case, would you be able to convert at probably a lower tax rate than you're going to be in retirement, you also have lots of time to let it grow. And I always say Roth conversions come down to the two T's, taxes and time would be on your side.
Yeah, because if you've got somebody who's, about to retire, it really doesn't make sense to do a Roth conversion in 2026 and then, take it out the next year. It most likely doesn't make sense. Yeah. It really is keeping it in the market, getting those tax-free gains. There's a couple scenarios where I've seen it really work out. One of those, and this is for people getting ready to retire, one of those is, let's say one of your husband or your wife, your spouse, they retire early and your income tax bracket goes way down, but you're not retiring for a while, that's usually a good window to do it. Now, it's different for everybody, so I'm not going to say if that's your scenario, start doing it. You'd want to talk to somebody and see if that makes sense for you. So that's a scenario that works great. But like you mentioned, it's really good for young people because we're in a low tax bracket and we plan to be in a higher one. Another one, I've seen people who they go work fun jobs before they hit age 65 and they're not making a lot of money relative to how much they made in their career.
Right.
And it's kind of a no-brainer. Like, you're in a low tax bracket now.
Yep.
Let's go ahead, do the conversion, and let that money grow for a number of years.
So what I'm hearing you say is less likely in the final years of your work life and more likely in the first couple of years of your retired life is when it could potentially make more sense. Now, the other piece of that, and this is a big inhibitor for a lot of people when we get this far in the conversation, is you don't pay the taxes out of the converted amount. You want to invest it all, right? So if you convert $50,000, move it from your pre-tax IRA and convert it into a Roth IRA, and you owe $15,000 to $20,000 in taxes, you need the cash on the sidelines to pay that come tax time. You don't want to take it out of the investments. And that's a big inhibitor for most people because A, they either don't have the cash to do it or they don't want to part with it. So that's a piece that you have to consider. Now, that's the tax piece to it and the time piece to it. It could make sense if you're wanting to just leave tax-free money to your kids, because the other piece to this is, as we know, and we've talked about many times on this show, the inherited IRA rules are different than they were 6 years ago. In 2020, the rules of the game changed dramatically. Rather than your heirs being able to take that out a piece at a time, the inherited money, based on their life expectancy, they now have to withdraw it in 10 years. So if you are going to pass on a couple of $1 million, especially to a single or two heirs, that's going to be a big tax bomb in their lap. So if your goal is to stop that from happening, yes, peeling off a piece at a time every year, converting it to a Roth, putting it in a Roth IRA, which still, by the way, does have to be withdrawn over the 10-year rule, but by the way, it's tax-free. So it's not going to be a problem for your kids to get it out of that Roth IRA and do what they want to or need to do with it. So that's a piece to it. I think what oftentimes makes sense, there's another choice here. You know, he asked about, do I wait till RMD age to pull out or do I convert now? That's not the only options on the table. I think what we see, Alec, and in higher net worth individuals, this is quite common, but they don't need the money. They have other income streams. They don't really take withdrawals from their IRA, but it might be a good reason to do that, to build a retirement income plan, start pulling out of the IRA now so you can manage that account value later. Mm-hmm. And that's what we do every day.
Yeah. So one thing that you mentioned that I really like is just having a diversity of how your assets are taxed. And, you know, if you don't need a lot of those assets, you do have more flexibility to do that. So, and I'm kind of going a little bit on a side tangent, but if you do have non-taxable or non-retirement money rather, then you have traditional retirement money and Roth money, it really lets you pull the levers on how your taxes look in retirement.
Yep.
And you may have a certain point of years where you can really control your tax burden, and having those Roth dollars, that really helps you. For example, if like we have retirees all the time who say, I need this amount of money to buy a car, and that's more money than they would typically take in a year, so their tax bracket could go higher because they're taking, for example, 30 grand more.
Yep.
But if you have non-retirement money or you have Roth dollars, taking that 30 grand out, it doesn't shoot you into the next bracket. And so, or at least it's not more money that's taxable to you. So I think, like you said, be strategic. And if there's years that you may not necessarily need as much from your traditional IRA assets, it could be a good time to do it. And it gives you that that flexibility to control your taxes later on.
Yeah, one more thing, too, to kind of wrap up on this question is another reason is not just the RMD, but what the RMD could do to you, not just from a tax bracket perspective. If you defer taking distributions from your IRA, let it grow, it gets big, and then when you hit RMD age, you're forced to take certain amounts out. It also could affect your Medicare premiums. A lot of people forget about considering that. Medicare premiums are actually adjusted upward based on your income. So if you make a lot of income in a year, you could be paying double, maybe even triple on your Medicare premium for each spouse. When you think about that, married filing jointly, doubling your Medicare premiums potentially because of the RMD sending you into a higher tax bracket. It makes sense to have a robust retirement income plan. Maybe Roth conversions are part of it. Maybe you just need to start taking money out at 65 and paying taxes along the way, managing your tax bracket along the way, and managing that account value on your IRA, beginning to unwind it, so that when you reach RMD age, it is more manageable. But at the bottom line here is make sure to reach out to a financial professional to see if it makes sense for you and your plan. There are a lot of factors, as we've outlined here, to take into account. This is the question of the week, though. Great question, one we get quite commonly in the meeting rooms. Johnny, thanks for reaching out. We want to send you a Get Ready for the Future Show tumbler for being named the question of the week. Just send us an email to claim it. You can send that to show@getreadyforthefuture.com. And on to our final question on the Get Ready for the Future show today. It's from Bob in Morrilton. I'm 70 and want to gift some of our money to our grandkids now while we're still alive. How do we do that smartly? Well, that's a great thought and sentiment, Bob. And I know a lot of people think about that, especially for the grandkids and the kids, and I think about that in my own life as I get a little bit closer. I'm not to Bob's age yet, but I'll be there before you know it. I think about, do I want to leave what I have to my kids so that they spend it after I'm gone, or do I want to see them use it now? I want to help them out now and be able to see the benefits that they receive from that, whether it's taking everybody on a big family trip or vacation, or giving them some money to put up for a down payment on a house so that they can be a homeowner. We all know how difficult home ownership is in this current environment that we're in. So I think it's great to think about giving away some of your wealth while you're alive and can see it be enjoyed or used by your kids or grandkids. But I would say, first of all, this goes back to the old oxygen mask analogy that we use so often on this show. Make sure your oxygen mask is secure before helping others. You got to make sure before gifting anything that your retirement is fully secure. In other words, Bob, do you know that you are financially independent? Have you built the retirement income plan to know that, so that you know how much you're going to need for yourself, and then the abundance that you don't need can begin to be gifted and given away while you are still alive. So let's understand the gift tax rule first off, Alec, because I think this one is misinterpreted a lot of times by people.
Yeah. So with the current annual gift tax rule, you can give $19,000 per person per year. Now, if you file as a couple, that doubles, so that's $38,000 that you can give, and there's no taxes owed by the recipient. But that's just how much you can give without reporting. If you want to give more, you actually can. You just need to report it and file an IRS Form 709. If you do this, it's going to count against your lifetime estate gift tax exemption, but that exemption is $15 million. So what that means is over your lifetime, you can give $15 million. Most Arkansans are not giving $15 million in retirement, but it's good to know that that is a rule out there. So you can give $19,000 if you're single, $38,000 as a couple, to any family member, and not have to report it. But if you want to report it, if you want to give more, just make sure that you report that.
So if your grandkids are underage, which I'm assuming if you're 70, you may have some over 18, you may have some under 18. If they are under 18, here are some other options for you in addition to the gift tax, or I'm sorry, the gifting money that you can give away money that way. You can open an UTMA or an UGMA. So that's a Uniform Transfer to Minors Act, a Uniform Gift to Minors Act. It creates these accounts that you are the custodian of while your grandkids are not or underage, they've not reached the age of majority, which is in Arkansas 21. I said 18 a minute ago, but it's 21 for the UTMA and UGMA accounts in Arkansas. The earnings are still taxed annually, so if you invest that, you'd still have to owe taxes on it. Some assets may be tax-free, at the child's tax rate. Larger amounts could be taxed at the parent's tax rate. They've got very little flexibility, though. I think the problem that I have with these, I've had some clients that have opened these prior to becoming a GenWealth client, and I'm going to tell you 100% of the time they regret it. And I'm sure that's not the case with everybody, but the big reason they regret it is you don't know when you open these and your grandkids are 7 or 8 or 9 years old where they're going to be when they reach 21. What kind of decisions are they going to be making? And here's the deal. If you open an UTMA or an UGMA, when they turn 21, that money's theirs. It is handed over the keys to them, and they can take it all out the next day. They could make wise decisions with it, but you have no control over it. And I think that's the problem with those. So it is an option, but you really have to trust that your grandkids are going to do what you want them to do with it. And if you don't care, maybe you don't care. But I've just seen some really rough stories from clients about handing over the keys to, not even a whole lot of amount of money, but maybe $20,000 or $30,000 at a time to grandkids who are not making good decisions. So I think the better decision here would be to think about tools like a 529. Now, people think of that as, well, what if I don't want it to go to tuition? Because they know that a 529 college savings plan, in that case, if you have earnings, they are tax-free when they're withdrawn if they are used for qualified education expenses. But this plan, Alec, has become more flexible with recent legislation changes.
Yeah, so they've made some changes that I think just make it a lot more attractive, because one big question a lot of people ask is, well, what if my kid doesn't go to college? And that's a valid point, is what if I just fund this thing with a lot of money and then they don't go to college? Well, one thing you can do is you could move it to the next kid, your next child. You can move it to a cousin, a grandkid. So you could find another kid who wants to go to college, but let's say that you don't have someone else that you want to move it to. You can actually convert this to a Roth. So it wouldn't be a Roth for you. It would be for your grandkid. But that's a great way to really get them ahead. If you had somebody who's in their 20s and their college fund is no longer needed because they either get a full ride or they don't go to college, and you can use that college fund as now a Roth IRA for them, they are going to be ahead of most people in their age group. Now, two things to know. If you want to convert this to a Roth IRA, there's a couple rules. So one of them, the Roth has had, or the 529 must have been opened for 15 years. So you can't fund it a few years before college and then a few years later just have this turn into a Roth IRA. It'd most likely be you set this up for your kid when he's younger, which you can do. They don't have to be 16 to open it. You can do it when they're 1 or 2 years old. So if you set it up early, it's been there for 15 years, your kid decides that he does not want to go to college, then you can convert this to a Roth. And also any contributions and earnings made within the last 5 years cannot be rolled over into a Roth. So wanted to make sure that y'all were aware of those two caveats.
And this does fall into the estate planning. I'm going to get to the final thoughts in just a second, but if we do offer estate planning services at GenWealth now, we've got an in-house estate planning specialist. So you can reach out today by calling 866-653-PLAN. That's 866-653-7526, or send an email to info@getreadyforthefuture.com and inquire about our estate planning services. Give you a little bit of time now for a final thought, as you heard.
Yeah. I think for final thoughts, today we went over a lot of different complex things, from life insurance, investments, annuities, savings tools. I think my final thoughts are, talk to a professional about all of these before you jump headfirst into them, because even today we just scratched the surface on a lot of these things. There's a lot more that we could have gone over, but just a little short on time. So make sure you talk to a professional and make sure it's right for your current scenario.
Yeah, I said it at the beginning of the show. This is for education purposes, right? And hopefully give you some action steps. But that main action step is for you to build a plan of your own. Reaching financial independence requires building a roadmap, a plan, and working with a financial advisor is a great way to do that. We do that for our clients every day here at GenWealth across all of our offices in Arkansas and Louisiana. If you want to set up that first appointment, it is absolutely free to set it up and to hold it. It is just a conversation about your goals. We'll ask you some questions and find out if we're a good fit for you. Reach out by calling 866-653-PLAN. That's 866-653-7526, or send an email to info@getreadyforthefuture.com. And that's all the time we have for this week's Get Ready for the Future show. Don't forget, I also said this at the open. If you have a question for us, send it in. Don't be bashful. Leave a voicemail or just shoot a text. 501-381-5228. We'll talk to you again next week.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.